Roughly 80% of married couples own a home together, and while it's extremely unfortunate for all those involved, divorce for this reason often involves couples trying to figure out how to split a property that they used to share. So if you're going through a divorce, just know that you're not the only one. But as you navigate this difficult situation, deciding what to do with the house is a big deal. So here's what you need to know about how homes, divorce, and mortgages impact each other. Property division in a divorce can vary from state to state, making it quite complicated. In community property states, each spouse, assuming that the home was co-owned, is entitled to 50% of the home's value. So community property states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In the other states, they follow what's called equitable distribution. Essentially, you or the court decide a fair distribution of the assets. So if the court feels that one spouse is more employable or educated, that spouse might receive fewer assets since it's easier for them to earn more after the divorce. Usually, if a married couple owns a home, they are co-owners and both names are on the mortgage. But in the case where this isn't true, this can also impact the division of assets. However, it's important to remember that homes are considered marital assets, so even if one person had nothing to do with paying the mortgage or maintaining the home, they may still be entitled to a portion of the assets. You don't need to sell the home in a divorce, but many couples end up doing so because it reduces the complications if a spouse that wanted to stay in the home couldn't qualify for the refinance mortgage on their own. But it's completely really up to you on what you want to do with the home. In any divorce situation, it's legal and acceptable, but maybe not fully advised, to completely divide the assets privately without the assistance of lawyers and courts. You could, for example, decide that one spouse gets the entire house because they had already bought it and paid it off before the mortgage occurred. Because divorces are often highly emotional events, not every couple feels that they can handle this type of task in a fair and equitable manner, which is often why it is necessary to involve divorce lawyers. Ultimately, if one spouse decides to keep the home while the other one leaves, the staying spouse will likely need to pay out the leaving spouse for the home's equity. By not selling the home, it will then be necessary to obtain an appraisal in order to determine the true value of the home, which will dictate how much the leaving spouse is owed. This is needed since the home's current price could be different than the price it was when the home was purchased due to changing market conditions. In a hot market, appraisals can actually come in lower than what the home would receive on the open market, so if you're the spouse accepting the buyout money, you may ultimately receive less than you would if the home was sold, and then ultimately want it to go to the open market. However, it's very difficult to force a sale during a divorce so long as the remaining spouse is willing to pay out. Now, once it's known how much the home is worth, a divorce mortgage buyout can be structured. So let's say the home is worth $300,000 and the couple owes $200,000 on the mortgage. They then have $100,000 in equity, so $50,000 would be needed to buy out the other spouse's share if they agreed to a 50-50 split. Although this payout doesn't need to be cash, the cost can be an offset with other marital assets like cars that the other spouse can keep. So for many, the cost is too much to bear, leading to the home actually being sold. Now, if you want to keep the house and you don't have enough equity to do a cash out refinance or the money to pay your ex their share, a HELOC or home equity line of credit could be the answer. If you co-sign your home's mortgage and then move out during the mortgage process, as long as that current mortgage has not been refinanced into just one spouse's name, you are still on the hook for the payment and the potential hit on your credit. By your name being on the loan, you are then legally responsible for making sure that the payments are made and made on time, even if you're not living in the home yourself. If a payment is missed, so going more than 30 days late, it then gets reported as a late payment on both individuals' credit reports, meaning it's going to impact both of their credit scores. Now, this is very important to think about, even if you and your ex-spouse have a very amicable relationship and they even agree to pay for everything. Having your name on the loan exposes you to financial risk. If something were to happen to them or they decided not to make the payment, you'd still be on the hook. Additionally, if your name is on the mortgage, but you still want to move out, you will struggle to get approved for another home loan until your divorce is finalized, since if you purchased before a finalized divorce, the ex-spouse would also then have ownership in that property as well. Now, here are some disadvantages to staying on the mortgage if you are not living in the home. Your credit can be penalized if the other person opts not to pay their half. You can be stuck paying for the entire mortgage amount if something prevents them from doing so. You may find it more challenging to qualify for credit or loan since the lenders will consider this debt for determining your debt-to-income ratio. Your home could be used as collateral to settle the other person's debt, such as through a bankruptcy. One of the easiest ways to remove a spouse or an ex-spouse in this matter from a mortgage is by refinancing, but you'll need to have an official divorce decree signed first by a judge, which is why knowing if you can qualify for the home on your own before making that divorce official is critical. When you refinance a home loan, you essentially receive a completely new mortgage agreement, and you'll likely receive a new term length and loan rate as well. In the mortgage divorce process, this also removes one of the spouses from title through a quitclaim deed. Divorce refinances are a specialized class of refinance and do not count as a cash-out refinance as long as the money taken out follows what is directly required from the divorce decree. For qualifying, it's important to remember instead of having two incomes to support the loan like you potentially had before when you bought it, now there's only the one income. Depending on how big that outstanding balance is and the current value of the home in today's market, that individual may or may not qualify for the home on their own. One of the drawbacks to refinancing is that it does cost money, but that same cost would apply if you sold the home and then you purchased a new home on your own. In the instance where you wouldn't qualify on your own, there are options such as looking for a co-borrower or asking a family member for a gift to come up with kind of a larger down payment on the refinance to try and reduce that loan amount might be needed, but all of this would be figured out in your divorce refinance pre-approval. Again, just another reason why you should be working with a mortgage-trained divorce specialist. In a divorce situation, leaving someone else in charge of making the mortgage payment can also lead to very stressful situations. Even if the other spouse communicated that, I want you to stay in the home with the kids, I'm going to make the mortgage payments myself, don't you worry. I would still move forward with that in caution because you want to be able to verify that. If the spouse does not end up making those mortgage payments, then after 90 days, it could start the foreclosure status process. And then that family who is in that home and they're in a house where the payments aren't being made, it could become obviously a really difficult situation. Now, I've stressed this a few times, but another thing to keep in mind during the divorce process is meeting with a mortgage advisor that is specifically trained in divorce mortgage, and this can really set apart your experience and set you up for success. Now, having this consult early on in your divorce process will really give you a quick idea of who can qualify for the mortgage on their own, and it gives you a better idea of what to do with possibly the biggest asset you as a couple own. For example, I have a divorce specialization called an RCSD. I'm also a master's level trained therapist, which means I'm able to navigate the situation as both a mortgage advisor and a counselor therapist. Now, many times out of bitterness, I've actually seen one or both spouses ruin the credit of the other spouse. They decide that it's the other person's problem and then refuse to pay bills that may be joint accounts. Now, this can greatly damage your credit and keep you from being able to qualify for any loan or mortgage going forward. I would urge divorcing couples to keep paying all of their bills through the divorce process to protect their credit by all means, because that can affect you for quite some time. Close your joint accounts and get your own account set up. If you're arguing with your spouse over who's going to pay a bill and then you get a ding on your credit, it's going to be a lot harder for you to qualify for a loan in the future. Just one 30-day mortgage late for someone with perfect credit will take over 3 years to recover. Not really something you want to mess with.